Hey, what's up, everyone, my friends? I'm so happy you're here again, and I'm happy on this to share with you the another episode of Catch the Wave Strategy Advanced. I'm so happy you're here. Remember, this is Smart Life TV channel, and we talk about trading forex market, trading cryptocurrencies, and every other thing that could help you stay consistently profitable. We don't just do only trading; we do other things, and we try our best to share them to you guys. So I'm so thankful for your consistently in being with us, your consistency in being with us. I'm so grateful for that. So on today's episode, we are going to be talking about how to place stops. Now, this is not the training video on how to set your stop loss on MT4. This is just a video on how do you do it technically so that you don't get kicked. What are the reference levels when you look at the chart? What are the reference levels to place your stop loss? Remember, we've done top down analysis, we've done how to pick sniper entries on lower time frame, we've done many other things. So now we're going to do how to place stop loss. So today's episode is how to set your stop loss so you don't get kicked out prematurely. Have you ever experienced this scenario? You get in on a chart, you identify, let's say maybe you use a catch the wave strategy, you see a trend, let's say for instance an uptrend, you see an uptrend like this, and then you mark your key level like this. After marking your key level like this, price comes to it, and as price comes to it, you were so happy when you saw a confirmation. After seeing that confirmation, you were so happy, you begin to think of everything you're going to do with the money, everything you're going to buy with that money. And all of a sudden, the price, you enter the market, and then you place your stop loss, let's say around this level, and then the market just goes down lower, triggers your stop loss, and moves in your favor. And you begin to feel like, oh my god, the market is against me. The market knew that I placed my stop loss there. Of course, we've once or twice been in such, but we this video will guide you and help you so that you don't get that so often. You overcome stop hunting. This is called stop hunting. Why does that happen? The big players are there. They know that they are looking to eat into people's stop loss, make the money before they now place their buy orders, and then the price now moves in the intended direction. So just stay tuned with us, watch this video till the end, and I bet you will become a better trader. So talking about stop placement, there are different ways of placing stop loss. It's dependent on what you like and your personality, what works for you. Some people place tight stop loss, while some place wide stop loss. And I can tell you that no matter the one you do, you can be profitable with anyone. Yeah, you can be profitable with a tight stop loss of 5 pips, or a wider stop loss of 20 pips. Anyone you do, you can be profitable with it depending on what works for you and what you prefer, your point of view of the market. Now, tight stop loss. Why is it illogical to place a tight stop loss? First of all, when we're talking about key level is not a line. It's not a line. Although we can use the line to draw it. Let's say we see this market make a swing like this, the market make a swing like this, and then you identify this as a key level. When market breaks it and is coming back to test it, you say, oh, that's a key level. Of course, that's a key level, but you don't just place your stop loss just below it. Sorry for that. You don't just place your stop loss very close below it. The market won't just Most of the times the market won't just touch that line and start moving in your favor. The reason is because key levels are not lines. They are a wide zone, an area. So you can call it an area, of importance or area of value. It is a large area. At times, the market won't come into that line you drew. The market will just come very close to it and spikes in your favor. Why? Because the key level is not a line, it is an area. So have that in mind when placing your stop loss so that you know, okay, I want to place my stop loss below that area so that if market breaches that area, we know that yes, the market has broken the area, and now you can now call it okay, a break of structure or whatever. So just understand that. The second thing is that there are stop hunters. There is something in trading called stop hunting. Stop hunting is this scenario where you place your stop loss, you get into the market, you place your stop loss, and then it just triggers your stop loss and moves in your favor. Why is that logical? Or why does that work? Because most retail traders, they don't want to lose much into the market. Most retail traders are starting with small account. So what do they do to keep themselves afloat? They set their stop loss very close. They use tight stop loss so that if they are losing. Okay, let's say someone starts with $100 and is placing a 10 pip stop loss on Euro USD. What would that be? That would be a $1 risk, and that is 1%. So they're trying to place these tight stop loss so that when they lose small. And on the same hand, other bigger traders on the same trade are placing 20 pips stop loss. So the banks move this, it triggers most of the retail traders and begins to move in the intended direction. Most people are placing their stop at that level, so that is why it is a hotspot for the for the stop hunters to move the price just to that level and make the money before they start buying if it's in an uptrend. So they make money by selling in an uptrend. They sell because they have enough volume to move the market. So they sell quickly and then they now start buying. So that is stop hunting. It happens often in the market. So they want to eat your stop loss. So that's why this tight stop loss is illogical. So moving further, you also get kicked out immediately. I've explained that you get kicked out immediately than someone who places a wider stop loss. So now, why is it advisable to use tight stops? Why is it advisable to use tight stop loss? The first thing is that when you use a tight stop loss, you have a bigger risk to reward ratio than someone who uses a wide stop loss. Let me explain it using this simple diagram. Remember, all we're doing here is catch the wave, so let me stick to it. We have this market condition now, and market is pulling back. When you see this pullback, okay, I get in the market after a confirmation around here, and then I place a stop loss here. Let's say, for instance, this is 10 pip from entry to stop loss, that's 10 pips. And then the market moves from here to here, 30 pips. This is 1 to 3 risk to reward ratio. That is 30 divided by 10. 30 divided by 10, which will give me 3R. So 3 times my risk. So someone goes in with a 20 pip stop loss. A 20 pip stop loss. What will be the person's R multiple? That is 30 divided by 20. So what would that give me? That is 1.5 R. So 1.5 R. You see that, what is it here? If we both used $10 to go into this market, the person who used the tight stop loss is gaining $30. But the person who used a 20 pip stop loss is gaining what? He's gaining just $15. You see the trick there. So he gained even two times what someone who uses a tight stop loss will gain. So that's just one good thing about it. And the second thing is that your risk is kept small. If we are to use the same lot size, let's say, okay, they are all beginners, and then he uses 0.01 lot, that is a micro lot. So what would be his risk here? The person who uses the type stop loss will get, for let's say this trade moved against them, he will only get a $1 loss. But someone who uses a 20 pip stop loss will get a loss of $2. So you see how this thing goes. Your risk is kept small, and then you have a bigger risk to reward ratio. But the downside is that you get kicked out often. So let's move further. And there are people that like using wide stop loss. So why is it illogical to use a wide stop loss? Wide stop loss means bigger risk. The bigger your stop loss, the bigger the risk. On a trade where someone who used a narrow stop loss would lose $1, you could lose more. You would lose more because your stop loss is wider. Let's say he used 10 pip stop loss, and then you are using 30 pip stop loss. You're losing $3 on the same trade where he is just losing $1. So that is the downside. And then the second one is smaller risk to reward ratio. Smaller risk to reward ratio in that you have a trade. I explained it in the other one, so no need for much explanations here again. So the third thing is that you might miss some entries. How is that possible that you miss an entry? At times, those people that use wide stop loss, most of the times, if you're in my Telegram channel, you might have we have experienced it. You know me, I use uh, not too wide stop loss. I use the moderate size stop loss, but we experience that too. We miss some entries. When you see the market makes a move and we want to buy, the market makes a confirmation like this. And we see if we put our entries here, sorry, if we put our entry here and our stop loss here, let's say for a wide stop loss, this would be less than a 1-to-1 risk to reward ratio or 1-to-1 risk to reward ratio. But we want something bigger. So what do? We place buy limits close here. So sometimes the market won't move back to this level and start moving up. So what happens? The market just keeps moving straight. That means you've missed that entry because you placed your buy limit down. You've missed that entry. That is what it means by missing some entries. But on the other hand, wide stop loss is advisable because you hardly fall prey to stop hunters. Now the stop hunters, they just move the market against what it's supposed to move. Let's say the market is supposed to move up. They then place sales places because they have enough volume to move the market. They move it. It was going up, they move it down, trigger people's stop loss before they now exit the market immediately in a matter of minutes or seconds. And then the market starts moving in the intended direction. That is stop hunting. So you hardly fall prey to stop hunters. And secondly, you don't get kicked out often by insane market fluctuations. At times, there won't be stop hunters, but the market will just make some silly fluctuations, trigger a stop loss, and begin to move in your favor. At times, when this happens, the tight stop loss people get kicked out, but the people that use wide stop loss, they are still remain in the trade. They remain in the trade. The market, after making those insane fluctuations, it moves and then hits the profit target. So that's just the thing about them. So the most important question you'll be asking now is you've condemned and both commended the two types of stop loss placement. So what the heck? What do you now want us to do? that would be the question in everybody's mind. You just told us the do's and don'ts. Now what I will say is do what you feel is what suits you. If you're a small trader that can't, you won't be able to bear much risk and you don't have big account, you have no other alternative than to use a wide a tight stop loss so that you won't expose yourself to big risk in a market. So place your stop loss at a level where your setup gets invalidated if hit. I always tell myself this whenever I'm determining a stop level. Place your stop loss at a level where your setup gets hit. Where your setup gets invalidated if hit. That means if your stop loss gets hit or gets triggered. So how do you know a level where the setup gets invalidated? That is the question to be answered now. How do you know? You see a market condition. Let's say you're let me use another strategy, a breakout trader. And let's say the market moves in cycles, different cycles. The market is stuck within resistance and it's ranging, and after that it breaks out. It makes a breakout and you wanted to buy on this breakout. Okay, let me erase this. Let's say it breaks like this, it makes a breakout here, and you want to buy on this breakout to catch the bulk of the move, because everybody knows that after the market breaks out of a range, it moves explosively in one direction. If it breaks to the downside, it moves explosively to the downside, and if it breaks to the upside, it moves explosively to the upside. Breakout is a very, very explosive strategy, and you can catch massive pips with that. Most of the positional traders trade breakouts. So how would you do this? Now you get in the market here. At what point in time would you say this breakout is invalidated? When the market begins to revert back into this range, it means that it has been invalidated. So where would you place your stop loss? You would place your stop loss midway, reasonably midway into the range is logical. Some other less aggressive traders would place theirs completely away from the range. So anyone, if you place it away from the range, you have a wider stop loss, but most of the times the market might make a false breakout, move, retest the support level, and then move up again. So the thing is, most logical for me is midway. Once the market begins to come in here, it means that this breakout is invalidated. It means that this breakout did not work. So we begin to wait for another breakout to enter here and then place our stop loss, halfway again. So that's the logic behind it. Place your stop loss at the level where where your setup gets invalidated if hit. So I came with some hints for setting stop loss. Hints for setting stop loss. Now, most of the times when you want to enter the market, if you remember what I taught on top down analysis and lower time frame entries, you go to the lower time frame and you see a double top chart pattern like this. How do you determine your stop loss level? You see the double top, and once you see the double top, you place your stop loss just at this level, because this double top, as you can see, is a range. This is a range, a ranging market, but not it didn't range for long. It just made two tops as circled here and then begins to fall. This is simply a reasonable level. Just reference this retest highs as your level of placing stop loss. What if it's a head and shoulders pattern? Most people play when they see the head and shoulders pattern, and then the market make a head and shoulders, and then it's making a retest. They just place the stop loss above that retest. They place the stop loss above their retest, make their entries here. You see, you still have a tight stop loss. Although this is super reasonable, but you see, you still have a tight stop loss. You can also say, okay, this market might make a false breakout and then begin to fall back. You can reference this, the break of the right shoulder. You can reference the right shoulder as your stop loss level. Once you place your stop loss around that level, it means that the market can hardly make a head and shoulders pattern, and then a false breakout that will reach this shoulder. If the market can make a false breakout that will reach this shoulder, then everyone can call that invalidated. You've invalidated this head and shoulders pattern. So once you place it above the shoulder, that is most reasonable. Once it goes above the shoulder, it's not a head and shoulders pattern. So it has become invalidated. It has become what we can say, this setup is invalidated. We are ready to take the loss. Now look at this chart. As you can see in this chart, the market is respecting the trend line. Respect here, you can see this respect here, and then the third time. So when I see this, and then I also see that this is a key level because the market rejected here and came here the third time to make this test, this pullback. This is the pullback you see, and then the rejection. So most reasonably, one would want to enter here. Where would you place your stop loss? Below it. Let's say for someone that uses tight stop loss, we just say, okay, just below this would be okay. But let me show you what happened next after that. This is what happened next after the entry. So had it been we entered here and we placed our stop loss here, we would have been kicked out. So how then did we place our stop? And then after this, the market actually moved explosively in that direction. So this is what we might say that, okay, stop hunters are in the game because we see this big bearish candle shows that actually they stop hunted here. So we don't know whether it's stop hunters, we don't know whether it's just the market fluctuation. We can't tell. So you can see how the market moved just after hitting the stop loss of people that made it tight. Now the question on your mind would be, how do I then place stop loss? How do I determine my level for placing stop loss? Now, there is no good way, there is no holy grail about this, but I'll share with you what I do. There are different ways of placing your stop loss. You can just look at this swing and say, okay, I see this here, so I'll place my stop loss right below it. I'll reference this low as my stop loss level. So there is nothing bad about that. That's a reasonable way of placing stop loss. That's a reasonable way of placing stop loss, because the market might just come, retest these lows and move up again. Yeah, it's a reasonable way of placing stop loss, but as you can see, it's very, very far from your entry. Very far from your entry. But I'll share with you how I place my own stop loss. I place my own stop loss using the ATR indicator. ATR means average true range. Average true range. That is what I use to place my stop loss. And how do I do it? Once I just come to my chart, I put in the ATR. So once I see price comes into the support level, or the key level as you may call it, see price pulling back into it, I go and look at the ATR and see what the value is. You see, I put this line here, so let's see what the ATR value is. The ATR value for that time was 10 pips, so that is 0.0010. We can disregard that 4 because it's a pipette. And it's not up to 5. We can round it up. So what do? It's 10 pips there, so we just place our stop loss 1 ATR, that is just 10 pips below the key level. But for me, I use 1.5 ATR. That means 10 times 1.5, which is what? 15. 15 pips. So 15 pips from the key level, I just set that level as my stop loss. So that is just how I do it. That's how I do it all the time. And for me, it works for me. And you can also check out if it works for you. It's good because most of the times you don't get you don't fall prey to stop hunting. You understand? So I believe you've understood this. This is very, very powerful, and I'm so glad sharing this secret with everyone out there. It's my pleasure indeed. So please and please, we've come to the end of this video. Please subscribe, like the video, and please share to as many people as you know, even if they don't trade forex. Well, it might help them because I started trading forex just because I saw something like this. I didn't even know what they were talking about. I just saw it and I was like, "What the heck is this person doing?" And then I started putting my eyes in what was that, and I started with options trading. I couldn't place, and I couldn't just see 1 minute. You place a trade after 1 minute it closes. Then I go and then they teach me place your stop. How do you place stop loss? You just see, okay, buy, sell, time, 1 minute. How do you even do that? So that was when I now knew that this is not forex, this is options. So you can share this video to anybody. It might be of help to someone out there. So thank you very much for coming by. I still have you at heart. We'll cover everything. Other strategies are coming very soon. Breakout trading strategy, supply and demand, how to trade supply and demand levels, and a lot, how to trade range market, the 4 stages of the market, so you don't lose in the stage that a strategy works just to capture a particular market condition, and when you use it in a market condition doesn't suit it that doesn't suit that strategy, you will lose. So how do you avoid those market conditions? When you know the 4 stages of the market, you will be able to say, okay, this market condition, this strategy won't work in this market condition. So what other strategy do I use here? Or if I'm just using only one strategy, I stay out of the market till I see the market condition where my strategy works. So thank you very much. I'm so grateful you're here. My regards to you all, and I wish you success. I wish you good luck and good trading. See you in the next video on how to KHRH, keep half, right half, so that you know when to use that and when not to use it. You it's not to be used all the time. At times when you use it, you see that you just use it and then boom, the market just all the profit you would have made, you lost them. I'll guide you on how to use that too. So goodbye and remain successful.